If you're like many high net worth business owners, you likely face challenges when it comes to tax mitigation and building a retirement nest egg. The reason for these challenges is largely due to your higher income. There are many burdens associated with a higher tax bracket, including the following. You may phase out of benefits afforded to lower incomes. You may not have the level of tax deductions needed to substantially lower your income tax liability. Your savings may grow too slowly, and you may be left with inadequate retirement savings. The list can go on, but there is one tool that can alleviate these problems. A little-known retirement plan called a cash balance plan is an innovative way to help successful entrepreneurs like you. You can save as much as $2.9 million tax-deferred dollars for retirement, help reduce your annual tax burden, and accelerate your savings rate dramatically. So how does a cash balance plan work? A cash balance plan is a type of IRS qualified retirement plan known as a hybrid. In a cash balance plan, each participant has an account that grows annually in two ways. First, as an employer contribution, and second, as an interest credit. This interest credit is guaranteed rather than dependent on the plan's investment performance. The employer contribution is determined by a formula specified in the plan document. It can be a percentage of pay or a flat dollar amount. The interest credit for smaller plans is usually a fixed rate of a return of around 4%, and for some larger plans, an actual rate of return may be appropriate. When participants terminate employment, they are eligible to receive the vested portion of their account balance. Plan assets are pooled and invested by the trustee or investment manager. If the plan's investment earnings exceed the guaranteed rate, the excess will be used to reduce future employer contributions. This will not affect the amount that is credited to the participants' accounts. Conversely, if the plan's investment earnings are less than the guaranteed rate, future employer contributions will be increased. This makeup is typically spread out over 7 years. A wide range of investment vehicles can be used by the plan sponsor to achieve the interest crediting rate. Cash balance plans can be offered in addition to a 401k plan, profit sharing plans, or other plans. An employer can offer a combination of qualified retirement plans in order to produce a larger contribution. In fact, in most cases, a 401k profit sharing plan in conjunction with a cash balance plan is necessary to produce the desired owner and employee contributions. When it comes to distributions from the plan, any vested account in a cash balance plan can be paid as a lump sum distribution or annuity. A lump sum distribution can also be rolled over to an IRA or another qualified retirement plan. You can also change contributions to the plan, but with some restrictions. Cash balance plans can be amended periodically to permit different contribution levels. Usually reductions must be made before an employee works 1,000 hours during a plan year. In addition, a plan can also be frozen or terminated. Certain 15 to 45-day notices are required for participants when benefits are reduced. Everyone in the plan does not have to participate equally, and each participant can have a different amount contributed for them. Tax deductions for contributions made on behalf of non-partner employees are taken on the partnership tax return, while tax deductions for contributions made on behalf of partners are taken on their personal or corporate tax returns. However, to be sure that the amount deducted for tax purposes by a partner as shown on Schedule K1 is the same as the amount contributed on behalf of the partnership's agreement must permit this method of allocation. Most partnerships that adopt cash balance plans do not want the partner's contributions allocated like most other firm expenses in proportion to ownership. Either the partnership agreement or internal policy should assure that each partner is allocated an appropriate share of the plan's costs. The current tax law offers a significant tax break for pass-through business owners, but exclusions and limitations may prevent many professional service firms from benefiting. Fortunately, cash balance plans offer a greater advantage than ever. They allow some owners to reduce their adjusted gross income enough to qualify for full deduction of 20% qualified business income. The current Biden administration wants to phase out the 20% deduction for qualified business income for upper income taxpayers over the next 4 years. Although it may appear that cash balance plans are more expensive to set up and maintain than 401k profit sharing plans, cash balance plans are typically more cost effective. Due to the legal contribution limits imposed on 401k and profit sharing plans, combined with fees to cover the high cost of plan administration, 401k plans are a more costly way to deliver retirement savings. Cash balance plans ultimately help employers and participants save more with significantly higher tax deferred contribution limits and major tax deductions. If you are a business owner or a CPA that has clients who are business owners, then you should consider having my case design team run a wealth report using our software. We can see if a cash balance plan makes sense for you.